Troubled base Philadelphia bank, Republic First Bank, was collapsed and was seized by state regulators. Fulton Bank reached an agreement with regulators to take over Republic's first nearly 36 branches in Pennsylvania, New Jersey, and New York. They will reopen under the Fulton Bank name. This branch in Media already has a temporary sign-up. This is the first regional banking failure this year.
Bank failure 2024 occurred late last night, and people are trying to sweep this under the rug, trying to act like this is no big deal.
Assets and accounts are now being taken over by Fulton Bank, effective immediately.
This bank had $6 billion in assets, $4 billion in consumer deposits. Now, what if I were to tell you that this year we're walking into a disaster in the U.S. banking system for a variety of reasons that Americans simply are, they're not being told the full story. Did you know March 26th of 2020, they put in a policy to where all banks throughout America do not have to have a single penny of your money in their banks. They can issue all the loans that they want, but they don't need to actually have the money. They don't need to have any of this money. And so what happened last year is they brought something forward after Silicon Valley Bank fell, First Republic fell, the disaster with Credit Suisse, PacWest got acquired by Bank of California. There was a lot of problems in the banking system, so they brought this bank term funding program out to help regional banks. And these banks, they borrowed $161 billion to try to keep the lights on. But they ended that program last month, March 11th. And this program, now all of these banks have to pay back all this money over the next 10 months, 10 and a half months. And the ones that don't are going to walk into a very, very significant problem. Now in this video, I'm going to break this down for you. I'm going to show you exactly what's going on in the U.S. banking system and why I believe we're walking into some serious problems here in America and why Americans need to get prepared for, things to look a little bit bumpy, to say the very least, going forward. Take a look at this. So the new low reserve tranche will be effective for all depository institutions beginning January 1, 2024. Effective March 26, 2020, the board reduced reserve requirement ratios on all net transaction accounts to 0%, eliminating reserve requirements for all depository institutions. Think about that. All depository institutions. Now, this bank that failed yesterday, they had $6 billion in assets, according to Forbes, $4 billion in American deposits in January. Now, this situation is very, very fascinating because what a lot of people don't realize is this. The FDIC appointed a receiver, said Fulton Bank, a unit of Fulton Financial, will assume substantially all deposits and purchase all assets of Republic Bank to protect deposits. Now they hear the FDIC, they think, look, the FDIC is my friend. They'll bail me out. If things hit the fan, I have less than $250,000 in the bank. They're going to bail me out without question. I'm not worried about it. Well, look at this. The FDIC, all they have is $121.8 billion. It might sound like a lot of money, right? It might sound like a lot of money, but all American deposits, total deposits, are $17.4 trillion. So they have $121.8 billion to secure $17.4 trillion. Now I know a lot of people are going to say, John, there's a lot of people that have way more than $250,000 in the bank. The reality is only 0.83% of deposits are over $250,000. So if you look at this 17 trillion, let's just say 10 trillion, 8 trillion are not, above the 250,000. How many people are actually going to get paid out on this FDIC? I would bet a very small percentage. And I would probably bet that Sally the hairdresser, Mike the plumber, Joe the nurse, or, Sally the doctor, they're not getting their money, right? If things really hit the fan here. I would bet that it's going to be the people that are, plugged in that are going to get paid out. And everybody else, as history shows us, are going to get stiffed. So this situation, this bank term funding program, March 11th, this allowed banks to deposit or to borrow $161.5 billion. And now they have to pay this money back. They have a one-year loan, so it expired March 11th. So, you think about this. A lot of people didn't take out their loan March 11th or March 10th, the day before it was expiring. They took it out last year when things were tough. Over the next 3 to 6 to 12 or to 9, 10 months, all these banks have to start paying back this loan in a balloon payment. How many banks are going to be able to do that? It's the real question. I'm betting not as many as people would like to think. And a Fed tool that buoyed U.S. banks put reserves in a spotlight. Now, when you look at what happened yesterday, they said the inflation report came out showing inflation is very, very high. And why this matters for banks is because it looks like interest rates are going to stay higher for longer, and that's going to put more pressure on banks because banks tend to invest in bonds and other securities which lose value when interest rates rise. So they've invested in bonds, securities, and commercial real estate, all of which are performing horribly. And at the same time, U.S. consumers pulled out $872 billion in deposits year over year. You think about that. Why? The cost of living is absolutely crazy. Everything is extremely expensive. Many Americans don't have the leisure of saving. They have to spend their money. And so this is another big headwind for banks. I mean, look at this. Majority of large U.S. banks posted declines in their deposit balances year over year, with almost 30% of $871.6 billion industry-wide decline attributable to the big four banks: J.P. Morgan Chase, Bank of America, Wells Fargo, and Citigroup. Now, this scenario that's unfolding here, investors price in growing chance of another Fed interest rate rise. It's going to put people into a different place, financially and mentally. They're looking at everything on the writing on the wall. Even Jerome Powell is saying Powell warns commercial real estate woes will lead to bank failures. This is a problem that we'll be working on for years. Now look, they're not working on this. They know it's coming. Because it's the biggest rug pull ever for.
Alright guys, so the US economy is in trouble and the dollar's taking down global currencies. And all this stems from the Fed keeping interest rates high. And why is this? Because inflation is still a persistent problem. We are witnessing a snippet of the endgame where the US economy is starting to lose control, where deficit spending doesn't move the needle anymore and stagflation is here to stay. Core inflation in the US has risen once again in March, which is a big problem. Inflation came in red hot, hitting 0.3% in March. Spending is also up, reaching 0.5% as well. Households in the US, they are spending more than the estimates. And to Powell, this looks like the economy is booming. This isn't really good for the Fed. They know the economy is in trouble. The big problem is the high interest rates. The Fed funds staying at 5.5% is starting to smash the global economy into pieces. Now you compound this with endless government spending from Joe Biden. It's a recipe for disaster. A hard landing could sneak up behind us.